Good day, ladies and gentlemen, and welcome to the Q1 FY23 results conference call of the Phoenix Mills Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. The management of the company is being represented by Mr. Shishir Srivastava, Managing Director, Mr. Anurag Srivastava, Group Chief Financial Officer, and Mr. Varun Parwal, Deputy Chief Financial Officer. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. At this time, I would like to hand the conference over to Mr. Shishir Srivastava. Thank you, and over to you, sir.
Thank you. A very good afternoon, ladies and gentlemen. We welcome you to discuss the operating and financial performance of the first quarter of FY23. Quarter 1 FY23 has historically been the best ever first quarter we've had across our retail and hospitality operations, two sectors that were hit hard by the pandemic. I hope you've had a chance to look at the results presentation shared by us. It is uploaded on the stock exchanges as well as on our website. I will now take you through the key highlights of the results and will refer to relevant slides of the results presentation from time to time. We will start with the performance of our retail portfolio. Please refer to slide 3 onwards of the results presentation. Consumption in Q1 FY23 was at 21,905 million. This is a 23% growth over Q1 FY20 consumption. If we exclude Phoenix Palacio Lucknow, the contribution by that mall, we have seen 11% like growth compared to Q1 FY20. Q1 FY23 saw the highest quarterly consumption done at our malls in the first quarter of any financial year. And please note that this was achieved despite the end of season sales being delayed to the month of July this year. Consumption was robust across categories. Some of the top performing categories were jewelry, which was up 115% from Q1 FY20. Multiplex, which was up 73% from Q1 FY20, and electronics, which were up 33% from Q1 FY20. If I may draw your attention to slides 4 and 6, we have seen the retail consumption momentum continue in the months of July and August till date. For the month of July 2022, we recorded consumption of rupees 7,920 million, up 33% compared to July 2019. July benefits from the delayed start of the end of season sale, as well as revival of promotional activities and events across our malls. You may see images on slides 5 and 6 of performances by prominent artists, which remain a big crowd puller across our centers. Incidentally, the July 22 consumption is the highest ever consumption recorded in our history and surpasses the previous high witnessed in December 2019. If I may draw your attention to slide number 7, we have achieved consumption of almost 30,000 million year to date, April through July 22, up 26% compared to the same period pre-COVID. If we annualize the year to date performance, I would estimate that we can target an annual consumption of at least rupees 90,000 million. We believe that we could surpass this figure of 90,000 million on account of multiple reasons. The first one being new trading area becoming operational across existing malls, sustained consumption growth, our new mall openings in the second half of this financial year. This is of course subject to there being no disruption in business operations. If you turn to slide 8, you will notice the retail expansion that we have outlined at our flagship retail property, Phoenix Palladium, Mumbai. The GLA in Phoenix Palladium was at about 0.77 million square feet in FY22. We have now activated a further 150,000 square feet of new area across the lower ground floor, first and second floors of Palladium, along with additional new areas in the zones of Courtyard and the East Zone of Phoenix Palladium in this quarter. In addition, we will add another 250,000 square feet of anchor space coming up opposite to PVR in 2024, and another 200,000 square feet or more area in Project Rise, which will become operational in 2025. Once the entire expansion program is completed in 2025, Phoenix Palladium will be approximately a 1.43 million square foot GLA mall, the largest in our portfolio. If I may draw your attention to slides 9 through 11 for a quick glimpse of the new store openings at Phoenix Palladium between July and August and across categories of fashion, F&B, and entertainment. In line with our consumption, our rental and EBITDA growth has also come strong. First quarter FY23 rental income was approximately rupees 3,224 million, up 24% compared to quarter one of FY20. Our retail EBITDA for this quarter was about 3,248 million, up 27% compared to the first quarter FY20. Our collections during first quarter FY23 stood at about rupees 5,253 million, and going ahead one can expect quarterly run rate of at least rupees 5,000 million here onwards. For a perspective, our FY22 retail collections were rupees 11,740 million. If I draw your attention to slide number 25, in today's inflationary environment, our retail and hospitality business, which are consumer facing, stand to benefit. Higher prices of goods sold at the malls translates into a higher consumption, which translates into higher rental income for us by way of the incremental revenue share. At a broad level, approximately there was an incremental rental contribution on account of revenue share beyond the minimum guarantee rent of approximately 13%. If I may draw attention to slide 25, Bangalore has shown an incremental rent on account of revenue share of about 18%. Phoenix Market City Pune at approximately 16%, and Phoenix Market City Mumbai at approximately 15%. Again, for a comparison, pre-COVID, the revenue share contribution would vary in the range of about 10 to 12%. Moving on to our under construction malls, and if I may draw your attention to slide number 12. Phoenix Citadel Indore, with a gross leasable area of approximately 1 million square feet, has achieved 83% leasing occupancy. Palladium Ahmedabad, with a GLA of approximately 770,000 square feet, has achieved 98% leasing occupancy. We expect to commence operations for both of these malls in the second half of this year, and we are working at a furious pace to deliver the project. Phoenix Mall of the Millennium at Pune, with a GLA of about 1.1 million square feet, has achieved 73% leasing occupancy. Phoenix Mall of Asia Bangalore, with a GLA of approximately 1.2 million square feet, has achieved 76% leasing occupancy. We expect to commence operations for Phoenix Mall of Millennium Pune and Phoenix Mall of Asia Bangalore in the first half of FY24. At our flagship property at Lower Parel, Mumbai, we have commenced the shore piling work for Project Rise in June 22. For our upcoming mall-led development at Kolkata, we have recently received the approvals of building plans in April 22 and expect to commence construction in the coming months. Additionally, with the expansion, we have also commenced work on our offices at Phoenix Asia Towers at Hebbal, Bangalore, and commencing work at the Millennium Towers, which form part of the mixed-use development at Wakad, Pune. Once our under-construction malls have become operational, Phoenix will have an operational portfolio of approximately 13 million square feet. We continue to evaluate the growing consumption strength and patterns across key Indian cities and specific micro markets and continue to explore newer opportunities for us to benefit from this potential. The potential to tap the discretionary spending of urban India is huge in our view, and as owners and operators of one of the largest retail portfolio in India, we are committed to provide the urban Indian consumer the opportunity to experience the best of retail brands, entertainment, and superlative F&B options from across the world. I will now request Anurag to take you through the office, hotels, and residential section and overall financial results. Thank you.
Thank you, Shishir. I would now take you through the commercial portfolio. If you can refer to slide 27. During this quarter, we saw a gross leasing of 1.9 lakh square feet, of which 1.3 lakh is the new leasing and 0.6 is the renewal. Total office income stood at about 403 million, which is up 10% year on year, and total EBITDA stood at 235 million. Our collections from this business in this quarter was 464 million, which represents a collection efficiency of about 95%. For updates on hotels, please refer to slide 30 to 33. I would first cover the St. Regis. However, across both our hotels, the business has shown a strong improvement on back of higher occupancies and ARRs on account of social events, corporate events, and pickup of food and beverage segments. Both our hotels saw occupancy and ARRs which were higher than pre-COVID period. Now, coming specifically to each property, at St. Regis, our total income stood at 830 million, which is about 19% up over Q1 of FY20. Occupancy at about 85%, which is up by 3 percentage points from Q1 FY20. ARR close to 12,000 at 11,997, again up 10%. Operating EBITDA stood at 318 million, which is a 26% growth on the Q1 FY20. Hotel maintained a strong revenue performance in July, as well as with room occupancies at 81% and ARRs at around 10,800. July 2022 revenue is approximately 15% ahead of the July 2019 numbers. The operating performance at St. Regis Mumbai has surpassed most parameters in past couple of months, led by resumption of foreign travel, domestic corporate travel, social events, and staycations. These factors provide an excellent visibility of high occupancy and ARRs in the coming months. Additionally, we expect the venues on 38th floor to start generating revenue from the coming month, which will further boost our revenues. On the Courtyard Marriott Agra property, the total income was 40 million, up 7% from Q1 FY20. And for the occupancy stood at 62% and ARR at 3733, which is up at 11% from Q1 FY20. For the month of July, the occupancy was 72%, which is quite high, and ARR was at 3673. Moving on to residential business, which is covered in slide 35 onwards. We have witnessed a very good traction in residential sales as well, mainly led by reconfiguration of our Kesaku property into smaller units and robust demand of ready-to-move-in inventory. We achieved an overall sale of 704 million in this quarter, out of which 408 million worth sales is pending registration. Collections were quite robust at 536 million. This was the business update, and now I would like to move towards the financial results, which are there in slides 37 to 39. Some of the key highlights are income from operations in quarter was about 5744 million. This is up 181% year on year. Last year was the COVID-impacted quarter. EBITDA for Q1 FY23 was 3229 million. This is up 10% if we compare to Q1 FY20. On slide 39, we have represented how the consolidated EBITDA looks on a like-to-like basis after making certain adjustments on both periods, which we thought were the true representation. We have removed contribution of Classic Mall, which we have acquired now Classic Mall is a subsidiary of ours. We had acquired Classic Mall in last quarter. Further, we have removed EBITDA contribution from Felix Palacio in Q1 FY23. We have adjusted EBITDA contribution from a residential business from Q1 FY20, which saw the revenue recognition of TAR 6 in Q1 FY20. After making the above adjustment, consolidated EBITDA shows a growth of 21% on a like-to-like basis. We have reported a Q1 FY23 PAT of 7187 million. PAT is positively impacted owing to exceptional items of 5,568 million. PML completed the acquisition of balance 50% stake held in Classic Mall during Q1 FY23. Pursuant to this acquisition, remeasurement of previously held stake of 50% in then the associate investment in Classic Mall at fair value was required as per the Ind AS 103, leading to a positive impact on PAT. If we adjust the reported PAT on the above exceptional item, we are looking at a 18% growth on the adjusted Q1 FY23 PAT over Q1 FY20. Moving on to debt and liquidity and funding, slide 40 to 42 are the reference slides. Our consolidated gross debt stood at 41,865 million on 30th June 2022 as compared to 43,785 million at the end of Q4 FY22. There is a reduction of debt of about 1930 million. On the operational portfolio, there has been a decline in debt due to gradual repayments as well as few planned repayments that we have done during the quarter. On the under construction portfolio, sequential increase of debt is on account of pending for our under construction mall at Ahmedabad and Indore and Bangalore. Average cost of borrowing is up about 15 bips at 7.45% from a 7.30% in March 22. Currently, our lowest cost of borrowing stands at about 6.95%. As the overall interest rates in the economy start to rise, our effort will be to minimize the impact of this on our cost of borrowing. Despite RBI increasing rates of 140 bips since May 22, our borrowing costs have only gone up by 15 bips so far, although the cost of debt is likely to move up in coming months as the banks pass the rate hikes and we hit our refinancing windows. We have potentially another 30% of debt portfolio which we can aim for refinancing during FY23 towards the Q3 and Q4, which could yield us interest rate benefits of 30 bips at a portfolio level as compared to the rate increase on the repo rate increases. Liquidity. Our liquidity position as on 30th June 2022 was almost around 21,772 million. This excludes the 8,070 million in unutilized OD accounts which we can draw at any point of time. At a group level, our net debt is 20,094 million and PML shares of net debt is about 16,899 million. I wanted to take you through the cash flows as well. Our gross collections from the business was at 7,164 million for the first quarter of FY23. Retail business saw collections of 5,253 million, commercials at 464 million, residentials 536 million and hotels contributed to about 911 million. On 30th June 2022, we received the balance commitment of about 4 billion or 4,000 million from GIC. As a result, we now hold 67.1% in Phoenix Market City, Pune, Mumbai and the commercial assets forming part of Phoenix Market City, Mumbai. Our capex on under construction retail and office projects was 2,739 million in Q1 FY23. We have 4 malls under construction at present and pace of spending will pick up going ahead as they enter into the final stage of completion. Further, we have started construction for Project Rise during the quarter. Our cash flows from operating activities was at rupees 3,417 million, adjusting for interest paid of 875 million. Our operating free cash flow for this quarter was 2,543 million. It is pertinent to note that our operational free cash for full year FY22 was 5011 million. This number was rupees 6,000 million pre-COVID. Thus, our start of the year has been very strong, with quarter one itself accounting for around 42% of our FY20 operational free cash flow. We are bullish on our business prospects, and with a strong balance sheet position, our focus is now to deliver on our under construction projects in time and judiciously deploy our capital to expand our portfolio. With this, we close our opening remarks and will open the call for interactive question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thanks for the opportunity and excellent set of numbers. Very good to see that. My first question is on the breakup of the minimum guarantee and the revenue share rentals that you've given. Can you shed some more color on what has driven this breakup? Does it have something to do with lower minimum guarantee as well this time versus last year, or is minimum guarantee versus FY20 also a significant jump up?
Would you like to, hi Puneet.
Hi.
Would you like to refer to slide 25?
Yes.
So if you really look at the incremental here, first and foremost, the consumption itself is significantly higher, right? So the contributing, the rupee value contributed per square foot on account of revenue share has certainly gone up.
Right.
If you look at the last column on the extreme right, it will show you what are the areas up for renewal in FY23, which indicates which of these contracts are towards the end of life or end of tenure, where there is an opportunity to increase minimum guarantee. What this means is that the delta between minimum guarantee and the actual rent received is quite high.
Okay.
So if you look at Bangalore, which has demonstrated an 18% additional contribution of revenue share towards rental, not many contracts are towards the end of tenure. So the delta between MG and revenue share is purely on account of consumption and not because MG is too low.
Okay.
Similarly, if you scroll down to Chennai, you will notice that the revenue share has moved up from 3% to 8%. But here the MG continues to be high in terms of the revenue share thresholds.
Yeah. So maybe I didn't frame the question properly. My intent was to ask how high is MG in 1Q FY23 over 1Q FY20 on a portfolio basis or on a mall by mall basis, whatever you want to
Q1 FY20 versus Q1 FY23. The MG,
yes.
I think the MG is not significantly higher. It may be across malls, it may be between maybe 8% to 15% on the highest side.
Okay. And the rentals also, if I look at one for Bangalore and Pune, seems to have been extremely strong. Is that the run rate one can assume, or can it be influenced by different sales momentum as well?
So
Hello?
on the rentals achieved,
Yeah.
I would look at it like this, that with the growth in consumption, Puneet, we are estimating the rental, including the revenue share, which used to track between 10-11% or closer to 12% in some cases, moving up to the 13-14% range. So stronger consumption is adding to a stronger rental income.
Okay.
And if we estimate consumption growth to continue to demonstrate going forward on a stabilized basis, continue to demonstrate, say, 12-15% kind of a early to mid-teens growth, that will contribute that additional 14% of such growth as well to the rental income.
Right. Understood. And is the metro work which was impacting the Bangalore consumption earlier, has that been completed or is it still going on, the performances despite that?
So the civil work for the metro and all the heavy work which was blocking the traffic in front of our mall, that has been completed. So a good part of that stretch coming all the way up to our mall has now become freed up from all the road blockages, and that has certainly improved the arrival experience and the time taken by visitors to our mall.
Right, understood. And any comment on Chennai? That still seems to be, weaker than the others.
Yes, but it has. I think it's given us a good indication going forward how it's going to look, with about a 8% growth compared to FY20 Q1. We have done a couple of things. One is we've reactivated all our high impact events, and that is clearly adding a lot to our consumption over there, and that trend will only continue. And as we continue to promote and actively market, have these high impact events, we had comedy shows there, we have had music performances at Chennai, which have all brought back the consumption to the mall. Additionally, we've also been looking at revamping that entire brand mix at Chennai, specifically Palladium, and that has also yielded some very positive results in the month of July and August for us.
Understood. That's helpful. Thank you so much. Two questions for Anurag and Varun. One is, what is the remeasured value now of your Classic Mall as per your books?
So Puneet, that number would be about 1,900 crores.
Okay. Equity. Yeah. And on the debt side, how do you expect your borrowing costs to change? Is your borrowing cost linked to repo, MCLR, and how frequently does it get reset?
So it's a mixture of various loans and various benchmark which it is there. Just for reference, I think because there is a lag between when the RBI increases the rate and when we see an increase in our portfolio. I think as we go along, if you see, RBI has increased the rates by 140 bips or so. Our overall portfolio as at March end would show an increase of about 110 to 115 bips. As the rate changes keeps on coming. The reason for that is we still have about 30% of our portfolio which we are renegotiating or refinancing with the banks. So that will give us some advantage of about 30 bips over whatever is the rate increase which gets translated into MCLRs or repo rates, etc.
Did I get it right? We should be expecting 110 basis point increase in your borrowing costs as of March 23?
Over March 22 number.
Over March 22. Understood. That's helpful. Thank you so much, and all the best.
Versus a 140 bips rate increase by the RBI.
Understood. Got it. Yeah.
Thank you. The next question is from the line of Parikshit Concall from HDFC Securities. Please go ahead.
I appreciate you. Congratulations on a good set of numbers.
Concall, if you're speaking, we are not able to hear you. I would request you to use your handset.
Hello, is it better now?
Yes, please proceed.
Yeah, so my first question is on the consumption for the month of July, which is like 133% of pre-COVID. If I adjust for the Lucknow mall, it's about 20%. So on a 3-year CAGR, it's still lagging behind, just about 6% kind of CAGR. Just wanted to understand if you can give us more granularity on like-to-like basis, because still in some malls the trading occupancies yet to reach the leased occupancies. On a like-to-like basis, if we have to adjust, what would be the consumption for the month of July? if we assume that the trading area remains the same on a like-to-like basis?
Sure, Parikshit. Varun this side.
Yeah.
So on a like-to-like basis, the growth would be about 21% compared to June 2019. As you correctly highlighted, trading occupancy across the malls right now is at an average rate of about 85%. Now there are several areas that are under fit out, and most pertinently, if you were to visit, say, Phoenix Palladium, you would see a lot of new areas that opened up in August, including on the second and third floor of East Zone, wherein we launched 8 new F&B venues as well as Time Zone. Now, those are substantial areas that have become rent generating from the month of August itself. So you will see the impact or positive impact on both consumption and rental income flowing through from these new areas during the coming quarter.
But specific to Kurla Mall, Chennai Mall, and Pune, where the occupancy still continues to remain low versus the leased occupancy. So when do we expect these going back to the leased occupancies? What's the time frame when we see them reaching their leased occupancy?
So I would say on Kurla, there are large areas that are under fit out on the lower ground floor. We have Reliance doing a major fit out, as well as a brand from Japan known as Daiso, which is undertaking large fit outs. So from that perspective, I would assume that around Diwali time is when those areas would become operational. What was the second mall that you had asked a question on?
Chennai and Pune.
So Chennai, like Shishir also highlighted in the previous response, there are, we are undertaking a brand mix change and upgrades to the mall, and we are carrying out some category changes. Now, Chennai, vis-a-vis the other market cities, became operational later. It became operational in 2013. So the brand mix change that we carried out in Pune and Bangalore in 2018 is now getting carried out in Chennai with a bit of a lag, accounting for COVID, etc. Yeah. In fact, if you refer to slide 64, you can see the leased occupancy at Chennai being 98 and the trading occupancy currently being about 95. Despite that, I think that if you see the trading density on a per square feet per month basis, we are seeing significant growth for the brands that are currently trading.
The second question is on on the upcoming office build out or construction in the 2 malls in Pune and Bangalore. So what has been the capex which is already being incurred? What will be the construction progress? Because we have given a timeline of FY23 of being operational for both these office spaces. If you can just touch upon that.
So on the offices, let me first start with Hebbal Mall of Asia. There we have already commenced construction, and majority of the slabs have been casted for the office floors. So if you assume, say, about 12 months for interiors and fit outs, then by this time next year, those assets would be ready for pre-leasing activities. For Pune and for Whitefield, we are in process. We have obtained the necessary approvals, and we should. Pune we have started, and Whitefield we will start soon.
If I may just add, see, these offices are being built on top of the mall podium structure. So for us, really, the construction timeline to complete the office floors is very limited because it's only building out the slabs, and you don't have to go down into the substructure for anything. So we are timing our office delivery basis what we are anticipating as the demand in those micro markets. Both Asia Towers in Bangalore at Hebbal and Millennium Towers at Wakad, Pune, we have the ability to really have them ready, as Varun mentioned, for pre-leasing within 12 months.
Okay. And what will be the capex on these 2 assets?
Cost to complete for Asia Towers, I think we have roughly around 270 crore as the budgeted cost to complete for Asia Towers.
Okay.
Sorry.
And Wakad?
And at Asia Towers in Bangalore is about 350, and for Wakad it's about 600 crore.
And how much would have been incurred till now in between the two?
So about 35 or 40 would be is what we would have incurred at Asia Towers, Bangalore. And we are just about starting work at Wakad. So nothing has been incurred there as yet.
Okay. Just last question, Shishir, on, I think earlier in one of the calls we have highlighted the focus on top 8 cities from business development side. So you had earlier, I think a couple of quarters back, you had spoken about Surat, you have closed something. So any update on Surat? And recently, I think you lost out on the Jaipur bid. So what's the update on the balance 8 cities or 8 markets? So how are you approaching these markets now?
No, we continue to be active in these markets that we had highlighted previously as well. Yes, Jaipur, we did step away from that auction after the price, kind of reached a point where it was not making financial sense. So we did not want. We've been very, very prudent about our approach. We are not going, we are not overreaching and overestimating the potential of these markets. And I think our final bid was a very fair bid, and the land transacted at a higher price, and we exited there. But we continue to be active in the markets of Jaipur, Chandigarh, Hyderabad for newer opportunities, among several others.
What about the Surat? Any update on Surat closure? I think you had announced it a couple of quarters back that you had closed something there.
We are still waiting for the vendor's CP completion, but it looks likely to be achieved very, very shortly.
So this year, Surat may happen. Besides Surat, anything else you are targeting in this year? Maybe another one where you have an advantage.
At this stage, it's too premature for me to, give a direction on that.
Okay, Shishir. Thank you and all the best. Those are my questions.
Thank you.
Thank you. Ladies and gentlemen, I would request the participants to limit their questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Adhidev Chattopadhyay from ICICI Securities.
Yeah, good afternoon, everyone. Historically, we have COVID and
Chattopadhyay, there is a lot of disturbance from your line. I'm sorry. We cannot hear you properly.
Is it better now?
Yes, please proceed.
Yeah. So the question was, see, in pre-COVID, in the 5 to 6 year period, we had seen the rental growth outpacing the consumption growth on a like-for-like basis. Now in FY23, could you just help us understand, let's say if the consumption growth is, let's say, within a 20-25% range on the consumption side, what is the likely rental growth we'll see on a like-for-like basis? Like, will it track consumption growth or will it be higher or lower? And how does it work out? That is the first question.
Yeah, it's a good question. For this current year, we expect it to be track higher than the consumption growth. In the first quarter, I think consumption growth was at about 23%. If we just look at the like-to-like mall, at about 23%.
I'm sorry to interrupt, sir. There is a disturbance from your line.
Adidev, would you like to go on mute while I respond?
Yeah.
Thank you. So in this first quarter, we've seen about 27% growth in rental, about 23% growth in consumption on a like-to-like basis. We would estimate that probably you may continue to see this maybe into 1 or 2 quarters of FY24 before it stabilizes and tracks consumption.
Yeah, sure. And how much of the rental increases would also play a part on this? Like, how much would be consumption growth, how much would come from the rental increases which you are planning, considering now that we have given the schedule right now for next 3 years. So how will that play out?
Okay, so I would put it like this, that rental increase on account of minimum guarantee increase to bring it in line with to track with the revenue share percentage is going to mostly happen more in the next financial year, not FY23, in FY24. That's where some sizable part of areas come up in 2-3 malls, and then the following year in some of the other malls. As revenue growth, as consumption continues to grow, our revenue share rupee value continues to increase, right? Because if we are tracking an average of about 14% contribution coming in from revenue share, I think that's where we will track. So I expect rental growth to be more on account of consumption growth translating into a higher revenue share. The reset of minimum guarantee will probably not breach that threshold for at least 2 years.
Sure.
Because minimum guarantee resets will now have a significant impact only in FY24 and then FY25.
Sure. That is pretty helpful. I'll come back in the queue with more questions.
Thank you.
Thank you.
The next question is from the line of Saurav Kumar from JP Morgan. Please go ahead.
Hi, Shishir. So, sir, just two questions. One is, if I look at the cash flow, and thanks for that disclosure, so the operating cash flow has now, crossed the 300 crore number, and if you kind of see it now funds the capex almost fully on its own. So the issue is essentially that you are also sitting on excess liquidity, and it seems that your cash flow will only grow from here. So, I mean, would you use the excess liquidity to now pay down debt, or do you have more acquisitions in mind? So, I mean, how should we think about the use of this excess cash which sits on your balance sheet? So that's the first one. And the second is, calculating this health ratio of your malls. So it seems that from a current quarter perspective, the rent to consumption ratio is about 13.5% odd. I don't know if that's the right metric. I mean, that's what you get, but effectively it seems to be at that higher end of the range, versus the other malls we see. So how should we think about this going ahead? These are two questions. Thank you.
Yeah. Thank you, Aditya. I'll respond to your second question first, which is the health ratio. When you mention that it is on the higher end of the range, that range continues to move depending on the performance of these stores, Saurabh.
Okay.
So while I'm not too sure which other malls you have tracked, but if you look at the performance of stores at our malls, with the consumption tracking much higher and actually breaching all historical levels at their stores, and their fixed costs largely remaining the same, right? Their ability to share a higher rent in terms of as a proportion to consumption is significantly higher. We have also been evaluating which formats, categories or brands are not being able to demonstrate their capability. And over a period of time, that's what the churn is all about, right? So when you are seeing some brands moving out and newer brands coming in, the new brands coming in have the ability to share or contribute 14, 15, 16%. In fact, India is at the lowest end of the range compared to global standards, where internationally you may see malls at averaging at about 20% or 25% rent to consumption.
Shishir, the limited point here is, I'm sorry for this follow-up, but effectively, so the rent to consumption works to about 13% odd. And then if you add the CAM and everything, then that ratio goes to that, maybe 16, 17%. So for a retailer to make money at these levels of fixed costs, I'm not sure if that's working out. How does it work out?
I would highly recommend that you speak to a few of our retailers and see how their individual store performance and profitability looks at several of our locations. To our mind, these are the stores that are profitable, and hence they have higher profit margins because of higher consumption, and hence they have the ability to contribute a little higher towards their occupancy cost. Moving to your first question, yes, we are seeing a sizable increase in our operational free cash flows. And when we look at the projects that we have underway and our commitment to fund a good amount of construction by way of our equity contributions, and having arrived at that understanding with our partners in the Canada Pension Plan, we've mapped out our cash flows, and we believe that beyond our obligations there, we still have the ability to acquire maybe one more mixed-use development in the shorter term within the next. So this goes beyond Surat, which is already under contemplation. We have the ability to at least look at another one in this immediate year without actually having to depend on any additional debt drawdown to serve that purpose. Going forward, like we've mentioned, we will continue to add 1 million square feet every year, and that will largely get funded from these operational free cash flows.
Thank you. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi, good afternoon. Shishir, just need your comment on the Ambience Mall Delhi, which is up for auction now. It's a new market where we don't have a presence. Would we be actively looking at this opportunity? And secondly, a more generic question on that is how is the opportunity landscape for ready assets in metros as well as tier 1 cities, and how is the competition for such acquisitions?
So, when we look at what has made Phoenix successful in the past and what we are best at is really demonstrating a huge equity upside when we look at a project through its development cycle and operations, right? For us to buy an asset which is going to demonstrate future yields of anywhere between 7, 8, 9%, that really doesn't fit in our model. Specifically, I don't have a comment on the Ambience Mall. It's a good mall, about 1 million square feet. I understand the reserve prices are close to 3,000 crore, 2,900 or 3,000 crore. I'm not too sure that fits our returns profile that we expect out of our investment. Yes, we have in the past also continued to look at other malls across the country. There are very few that will meet our brand specifications or product specifications. So we prefer to build from ground up or acquire brownfield assets like we did in Indore and at Lucknow.
Sure. My second question was actually a data keeping question. I didn't get the breakup of the collections between retail, office, hospitality, and residential, if you can share.
I'm going to request Anurag to give you that breakdown.
I covered that in my notes, but just to reiterate, the retail collections are about 5,253 million. Commercial were 464 million. Residential was 536 million. And hotel collections are at around 911 million.
So the retail collections 525, did it have any residual collections from earlier quarters, or is this going to be the sustainable number? Because it's higher than the rental income that we clocked. So
yeah, so it will be about 2 to 3% from the earlier quarter.
2 to 3% higher than the earlier quarter, you said?
No, so I thought your question was how much is pertaining to previous quarters, right?
Yeah, how much was the residual collection from the previous quarter in this 525 crores?
2 to 3%.
Okay, all right. Thanks.
Thank you. The next question is from the line of Pritish Seth from Motilal Oswal Financial Services. Please go ahead.
Hi, thanks for the opportunity. So first on, slightly on the macro side, so while, a government is trying to control the inflation by bringing down the consumption, historically, how that sort of economic strategy has worked for us in terms of consumption in our mall. Do you see any near-term impact on the consumptions because of that?
Pritesh, I would like to start by saying that inflation has been our friend because while we are continuing to see, let's say, interest rates go up and pricing moving up, we are seeing consumers spend also going up, because of higher pricing. So that contributes to our revenue share, and that's a positive. And we believe that with the corrective measures that are being taken on the interest rates and all, then this inflation will get capped very soon. So I don't think it's going to result in consumers or customers weakening or reducing their spend on a long-term basis.
Okay.
Yeah.
So you were saying something?
More so, just to continue, more so when we look at the location of all of our malls, we also believe that the impact of inflation may not be high in the urban cities, right? In urban India.
Yeah.
For our target customers.
Got it. Fair enough. And second is, on the consumption in market state Bangalore, which is like 149% of what we were at the pre-COVID, and that has been consistent improvements in last, quite a few months and quarters. Firstly, what's the reason for that? And secondly, does that have any, repercussions, positive impact on, our upcoming Mall of Asia, which is at probably much better location in Whitefield than this one. So how do you see that this increase in consumption in Bangalore?
Sorry, I have not really understood your question. Let me try and answer it in any case. Bangalore as a market has certainly seen a huge revival in terms of people returning back to that city, in terms of revival in hiring. We've also seen a huge demand in office space, which indicates that people are back at work. So I would say that the propensity to spend has returned back to normal as compared to pre-COVID levels. I also believe that the access to our mall has certainly gotten better with the completion of the metro work, which is driving more people into our mall as compared to, let's say, the 4 quarters before COVID, when this work had created some impact. Overall, we also, when we look at our location in North Bangalore, I would hesitate to say that that's a far superior location. Yes, it's a different market, and we are capturing the essence of that market by the product offering that we have there. We have focused more on higher end, premium and luxury brands, and we will have the first of many brands in that city opening their stores at our mall at the premium and luxury space. And that is also reflective in the minimum guarantee rents that have been negotiated for that mall. I would say retailers and us, our confidence is extremely high on the continued high consumption trend that we are seeing in Bangalore for both locations.
Right. So my question was, obviously you partly answered that. We are already at 160 per square feet rents in our existing mall in Bangalore, and for the upcoming mall, earlier you had guided that the rentals would be at 150. So are we sort of now looking at much higher rentals from the balance vacancies that we have in the upcoming mall in Bangalore?
I can say with a fair level of confidence that most of the transactions at North Bangalore are in line with the current rents that we have in at Whitefield Road, or slightly higher than that. So yes, we have looked at an upward revision.
Got it. Thanks. That's it from my side. All the best.
Thank you. The next question is from the line of Manish Agarwal from JM Financial. Please go ahead. Mr. Agarwal, I have unmuted your line. Please proceed with your question.
Hello. Hi, good afternoon. So, firstly, on the trading occupancies, across all malls, we have seen trading occupancies have gone up, but barring Phoenix Kurla. So, any particular reason?
If you look at Phoenix Market City, Kurla, we've actually created several new spaces for inline stores over there. If I may draw your attention to slide number 65, you will see that the leased occupancy is at 93%. So while trading occupancy is at 85, this gap of 8% is because those stores are under fit out, and or some of them have been upgraded and they're moving to different locations.
So as this
quarter, we expect most of these to be operational as well. Towards
and trading density would simultaneously go up.
I don't understand. Wait.
Yes, trading density, the gap that you see between trading density of 85% and leased occupancy of 93%, that gap will reduce during this. We expect that gap to reduce during this current quarter. If you look at the trading density, that has already moved up from it's in line with what was seen in first quarter FY22, with the brand mix also improving and that gap from 86 to 95 reducing and these stores becoming operational. Yes, the trading density also in our estimate should certainly move up.
Sure. And on the very next slide, so you have indicated around 30 to 40% of the leasable area will come for renewal across malls over the next 3 years. So any sort of expiry or churn we expect over the next coming years, since rentals have gone up significantly across malls?
Correct. So we are actually, I mean, the next slide clearly shows what is the renewal in FY23, what is the renewal in FY24 and 25. What was your specific question?
So any sort of expiries which might actually happen in this, or all the area which is coming up for renewal will get renewed for sure?
Oh, are you, okay. If your question is how many of these brands are going to continue to extend their contract or enter into a new contract versus how many will be exited. So the churn, I expect the churn to be in the range of about 7%, not more than that. And we expect other brands to be renewed either at the same location or other locations within the mall.
And you have an active pipeline to replace this 6-7% churn?
Sorry, what's the question again?
You have an active pipeline to replace this 6-7% churn which might come.
We have a host of new brands that we have concluded with for Phoenix Market City, Mumbai as well. If your question is specifically about Phoenix Market City, Mumbai. Yes.
Sure. Thank you. That's all from my side. All the best.
Thank you.
Thank you. The next question is from the line of Venkat. I'm so sorry. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Sir, thank you for taking my question. Sir, given what you managed to do at Palladium by increasing your space so significantly, is it just because this was one of our flagship old malls where we had, redundancies which we could do by exploiting the basement, etc.? Or can we expect similar things to happen in some of our newer malls as well? Because your expansion of floor area here has been pretty significant.
So we have the ability to expand the retail area across Phoenix Market City, Pune, as well as Phoenix Market City, Mumbai, as well as Phoenix Market City, Bangalore. These three malls, and these are currently the design progress is underway, but we do have this ability and we intend to replicate this approach across all locations. So in Phoenix Market City, Pune, there is the addition of a third floor. At Phoenix Market City, Bangalore, we are looking at an additional 2 floors. Phoenix Market City, Mumbai, there are 2 floors that we are contemplating adding by moving the courtyard to another level above. So I think this is a sizable increase across all 3 locations that we will implement in the coming year.
Okay. And can you give a sense of what that will be for each of the malls in terms of square feet?
Phoenix Market City, Pune, we should be able to add about 50 to 75,000 square feet. At Phoenix Market City, Bangalore, we have the ability to add about 300,000 square feet. And similarly, and at Phoenix Market City, Mumbai, the ability to add another 50,000 square feet.
Sure. Thank you.
Thank you. The next question is from the line of Venkat from Tata AMC. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. Sir, in a recent investor forum, you did speak about putting more capital to use in residential and warehousing, right? Could you kind of delve deeper into this particular plan? And generally, till now, our focus area has been largely retail and commercial, right? So any change in your areas of focus at a company level?
I don't think there is a change in our area of focus, as I think this question I had also covered in the last quarter's call, and I had explained that during COVID, it has been our realization that it would help to diversify our risk across more asset classes. Since during COVID, the hotel business and the retail business cash flows had come down to virtually nil, and the only cash flows that were coming through were from the residential sales and from the office business. So we are looking at diversifying, and at this stage, it's exploratory. We do not have any intent to allocate any significant amount of capital for warehousing. I had indicated approximately 170 to 200 crore kind of a number towards allocated towards warehousing, and I don't this would be more as pilot projects before we take the decision on investing or allocating more funds to that vertical. Residential, also we will probably look at an investment of about 200 to 250 crore to explore not to explore, but to exploit some opportunities in some very key markets where the demand continues to be high and the pricing is also extremely attractive, both from a acquisition point of view and the potential of the market to pay a higher rate per square foot.
Right. That's helpful. But just kind of pushing you a little further on this. I mean, we already have our plates full. There's a lot of opportunity already there in commercial and retail, right? And we may not be a sizable player in either residential or warehousing. So why put more capital to use on that front?
I would say for residential, one has to look at it as more of an opportunistic asset class where the investment would be low, but it can give us significant jumps in our cash flows on a periodic basis. And warehousing, I believe that Phoenix is very, very well placed to exploit these opportunities and build a very substantial portfolio once we've completed and seen the success of our pilot projects. Because of our relationships with the retailers who take up large space in the warehousing in key Indian cities, and of course our ability to deliver these projects where we already have in markets where we already have a presence. In terms of bandwidth, I think we do have the ability and the team to deliver both on resi and warehousing. And like I said, we are not looking at taking on too much at this stage. Warehousing is going to be more like a pilot project run under an independent team. And our resi team, with the way we have progressed with our projects in Bangalore and where we are today, our resi team has adequate bandwidth to take on at least 2 to 3 more projects.
Understood. And last question on this is, any focus cities that you've identified for these segments?
I would say for warehousing, Lucknow, Kolkata, of course MMR continue to be of interest, and NCR continue to be of interest. But Lucknow and Kolkata and MMR are high in terms of our interest levels. NCR we continue to evaluate. In terms of Resi, we have an exceptional team in Bangalore, so Bangalore continues to be an area of market of interest for us, and we are evaluating other opportunities or other cities which present opportunities.
Okay, sure, that's helpful. Thank you a lot, and wish you all the best, Shishir and team. Yeah.
In on retail and offices, we've spent about 4,500 crore of capex, and we have another 4,500 crore of capex lined up for retail and offices, right? So against a capex of 9,000 which has been committed on retail and offices, we've set aside a very small amount of roughly 350 to 400 crore for Resi and warehousing put together.
All right. And what would be the time frame for utilizing this 350, 400 odd crores?
Sorry, is your question timeline for utilizing? I would say
yes.
over the next 18 to 24 months.
Right. And beyond that, you may want to reassess depending on how your performance is.
Exactly.
Okay, sure.
Thank you.
That's helpful. Thank you. Thanks a lot. Wish you all the best.
Thank you. A reminder to all the participants to press star and 1 to ask a question. The next question is from the line of Amandeep Singh from Ambit Capital. Please go ahead.
Thanks for the opportunity. My question was on Phoenix Palacio. So when we see consumption for the mall on month-on-month basis, it remains stagnant in July. But at the same time, when you look at your top 5 other large malls, so consumption on cumulative basis increased 20% month-on-month for the reasons you already mentioned in the opening remarks. So can you help us understand what has been the reason behind this, and do you think...
Please repeat your question. I didn't get that.
So my question was on Phoenix Palacio. So when you see your monthly consumption June versus July, so it has been stagnant in terms of consumption at 760 million. But when you see the cumulative consumption for your other top 5 large malls on month-on-month basis, it has increased on 20%. So can you help us understand what has been the reason behind this, and do you think recent opening of Lulu Mall will impact the consumption for this?
So we are still assessing what impact Lulu Mall may have had on our consumption. I would like to mention here that Phoenix Palacio continues to perform in line with our expectations. So we had estimated that for month on month we will be in that, slowly creeping up to that 90 crore by the end of this financial year to hit a monthly run rate of about 90 crore. So we are in that trajectory. Other markets may have seen an increase and a jump, perhaps because more, as I mentioned, there are several reasons why Bangalore has done extremely well with the return of people to offices, return of people who had stepped away during COVID. Office demand going up has indicated that. In Mumbai as well, there's a high propensity to spend right now. I would not attribute any loss to our consumption on account of Lulu Mall, because we continue to evaluate the impact of that, if any. And yes, and the other thing is, we now also have the hypermarket that has opened up, and that will certainly add to the consumption, which so far was not adding to the consumption.
Fair enough. This was helpful. And just extending, it's just an extension to this. Will it be possible to help us understand what would be the average daily footfall for this mall on weekly or weekend basis, if possible?
Perhaps you can connect with Advait offline to understand that, because we don't actively track footfalls, since that's a wrong parameter to measure the mall performance. But we have all the data, and Advait will be able to share that with you separately.
Sure, that's helpful. That's all from my side, and all the very best.
Thank you.
Thank you. There is a follow-up question from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi Shishir. Just one question. On the area which is coming up for renewal over the next 3 years, So what kind of mark-to-market in your mind, I mean, in your estimate, is possible to be achieved here?
Mark to market on the rental? Sorry.
Yeah.
So,
Yeah.
if I draw your attention back to slide number 65, which shows what is the revenue share component as compared to the minimum guarantee. I would say that indicates the elbow room of about a 15 to 20% increment on minimum guarantee.
Okay. Got it. Okay, sure. Now, just one last thing on this residential, this balance area which is there. So, when do you expect it to get launched?
If your question is on towers 8 and 9,
yeah,
we have not yet decided on a launch date for these two. We are currently focused on completing tower 7, and sales is focused on the sale of tower 7 and of Kesaku. We are also waiting for towers 8 and 9. There's a dependency on the TDR policy clarification to be able to build out as per our development plan. So we're waiting for some clarity on that as well.
So between the two, the pending sales is about 1,200 crores between the two projects now?
Sorry, pending capex, did you say?
Sales value of the residual inventory. It will be approximately about 1,200 crores between the two projects now, excluding the towers 8 and 9.
Excluding towers 8 and 9, yes, I would say that ready inventory was at about 1,200 crore, but we've recently had some price escalation as well in the month of April this year. So it may have moved up slightly.
So and this 250 crores which you had to 200 odd crores in residential which you're looking to add, so how much of gross development value you're looking to add over the next 18 months from this pipeline? And also this will be on outright basis, or are you exploring JDA and other opportunities in the residential business as well?
You're now referring to about 250 crore of spend on 200 crore of spend on residential, right? So
yeah, which we are likely to spend in next few months.
Typically, I would say that would give us access to about, for a premium site, about one site, which can give us about 1 million square feet of saleable area.
And pre-sales of about 1,200 crores?
Sorry, your line is not very clear. Could you repeat that?
1 second. I was talking about this 1 million square feet will have how much of sellable value. So it will be more like...
In the markets that we are looking at a base price of being at least 12,500 to 13,000. So sales value will be about 1,200 to 1,300 crore. And let's say an EBITDA margin of about 35% on that.
And you're also exploring the JDA opportunities or only on outright basis?
No.
I mean, these are...
No, again, JDA opportunities will be very, very selective. Only if the site is superlative and unmissable will we consider that.
Last thing, on our existing malls or current assets, is there a potential to develop some resi piece? Is there a residual FSI which we can be utilized? Any thoughts there?
Sorry, at which location is this?
I'm saying existing malls or existing assets, is there, like how we are adding up office.
So our existing malls, the way they are designed, and we've obviously maximized the retail footprint across the site, they are not well suited for any residential development to use any residual FSI. We are utilizing the residual FSI in annuity assets such as offices.
Okay, Shishir. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. On behalf of the Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.